The economic crisis in 1998 began in Thailand when the Thai government decided on devaluation of the Thai baht in 2nd July 1997. The economy has entered a slowdown in 1998, which started from Southeast Asia, because cases in Thailand has affected Indonesia, Malaysia, Philippines, and South Korea, as well as spread beyond Russia, China, and Brazil. Among the factors that caused the financial crisis in Malaysia were speculative attacks, deficiencies in risk management, form of corporate governance and equity markets, and the legal infrastructure. The Malaysian economy was vulnerable due to a unsustainable pace of economic growth and overvalued exchange rate. The relationship between firms, government, and banks in Malaysia during the financial crisis period cannot be described as good compared to other Asian countries. There was no clear policy on directed lending to big firms, and to that extent, one cannot say that the financial constraints on big firms were weak. The government came out with a high growth policy based on a high ratio of investments to gross domestic product, complemented with the promotion and support of certain mega projects, which led to implicit assumptions by lenders that the government would not let those projects fail, which was helped by lending decisions by bankers based on not only a project's cash flow but also on collateral and implied government support. The overinvestment was fueled by an aggregate demand to outstrip aggregate supply, with a consequently persistent external deficit. Moreover, it had also led to a poorer cash flow and problem of loans. Later on, the deficiency in risk management caused by financial crisis had also affected the Asian region, including Malaysia, with huge mismatch between the assets and liabilities of enterprises, leading them to assume excessive liquidity, interest rate, and currency risk. The currency mismatch had also happened in Malaysia, with the exchange control regime requiring approval for foreign currency borrowing. Several prominent corporations were allowed to raise foreign currency loans, although they only had ringgit cash flow. Due to the sharp ringgit depreciation, these corporations were faced with massive foreign exchange losses or insolvency because of their currency mismatch and inabilities to hedge exposure. Moreover, the banking system in Malaysia was very risky, and this caused bad macroeconomics. The form of corporate governance and equity market was another factor that caused the financial crisis to occur in the Asian region. Asia was characterized by a concentrated shareholding system, non-competitive products market, and weak legal protection, as well as governance by large shareholders rather than managers, had reduced opportunity for management to specialize, poor diversifications of investment, and increased risk of expropriations of outside shareholders by insiders. The concentrated shareholding had resulted in a less developed equity market. In Malaysia, the equity market was very sizable. The news of outbreak of the regional crisis or corporate governance breakdowns and the weak responses to these regulators had led to a huge stock market shutdown. The problem was compounded by new rules on scrip livery, which was imposed to check the shutdown, even though these rules were scrapped later on. However, the initiatives taken to facilitate the development of suitable mechanisms for improved corporate governance were taken only much later, and those persisted on issues related to enforcement. The legal infrastructure system in Asia, and more specifically Malaysia, was plagued by inadequate reliance on markets due to its weak infrastructure in private contracting, which in turn was attributed to poor laws or weak enforcement of the laws. The investment decisions were based on the relationship model rather than on market prices, whereas contracts need not manage the supply of capital relative to investment opportunities, which were limited. In order to protect their interests, foreign lenders to Asian corporations and banks invariably made short-term loans, relying on the threat of not rolling over the loans to ensure borrowers service the latter. When the Asian economic crisis occurred, a majority of the lenders took back their loans, and this caused the capital to outflow without any control. This was considered to be a rational response by the lenders in taking their time and going to the courts to enforce their rights, given the poor laws and weak enforcement. Figure 1 shows the nominal exchange rate and stock indices during economic crisis in 1998. This figure plots the variation in the exchange rate and stock indices in local currency of 5 crisis countries, which are Indonesia, Malaysia, Philippines, South Korea, and Thailand, and also 3 non-crisis countries, which are Hong Kong, Singapore, Taiwan, assuming a base level of 100 on 1st January 1997. The 3 vertical lines represent 3 significant events. For the Part A, in 2nd July 1997, when Bank of Thailand announced a managed fraud. For Part B, in 17 November 1997, when South Korea abandoned its defense of the won. And for Part C, in 16 February 1998, when reports emerged that IMF had threatened to withdraw support. From the figures shown above, those countries suffered from the crisis 1998 experienced a sharp drop in value of currency and sharp decline in traded equity prices. This financial contagion has spread throughout the Asian countries. Between July 1997 to 1998, the currencies of South Korea, Indonesia, Malaysia, Philippines, and Thailand fell by 40% to 80% against the US dollar. The Asian financial and economic crisis has affected the US economy, especially in exports, because each Asian market is important in contributing income to US sectors. This has caused impact on industry which depends on export and gross output in US. The decline of exports from US to Indonesia, Thailand, Korea, Malaysia, and Hong Kong were particularly large, such as non-electrical machinery and miscellaneous manufactured goods. Yet, only China and Taiwan had strong economic growth in 1998, but also experienced a slow economic growth. In Malaysia, the economic crisis has brought impacts to economy and social. In the aspect of economy, the crisis has caused the weak stock prices, downturn of property market, negative wealth effects due to depreciation of ringgit Malaysia, and decreasing in domestic demand. In April 1997, the ringgit was equivalent to 2 ringgit 42 cents per US dollar, whereas later on the value of ringgit against the dollar depreciated by almost 50%, hitting a high of 4 ringgit 88 cents to the US dollar on 7 January 1998. Depreciation of currency affect declining in imports, but also slow the export. Besides that, crisis caused investors reduce their investment, such as foreign direct investment, to prevent loss. To stabilize the economy, government had reduced investment and expenditure, like reducing the budget for operating expenses by 18%, as well as cancelling or postponing several mega projects. Economic recessions during 1997 and 1998 has brought to inflation and unemployment. The inflation rate has increased from 2.7% in 1997 to 5.3% in 1998. The main factor of the increasing in inflation is due to increase in food price, which comprise of 34.9% of consumer price index. The other items that increase the price are miscellaneous goods and service, medical care and health expenses, gross rent, fuel and power, clothing and footwear, as well as transport and communication. The consequence of the higher inflation rate gives impacts to rising unemployment rates, lower wages, and reduced real income. The economic crisis is a plague that forced the employer to fire workers. During January to September 1998, Almost 88.1% or around 52,000 workers were retrenched by employers to cut costs. Employers also used some measures like salary cuts, temporary layoffs, and voluntary layoffs before taking the action of permanent layoffs. The economy in Malaysia was highly open and was much susceptible to domestic savings in order to sustain high investment rates to bring forward growth. Malaysia wanted to retain the advantage of its achievements in economic stability, but it was not an easy task, especially because of international economic policies had assumed political overtones. The high performance of Malaysian economy that was maintained over the decades, without markets or technology or even the core capital being local, cannot be undermined. However, in 1997, the financial crisis came to light, and essentially being a short-term phenomenon, it caused the crash of Malaysia's economy. The Asian crisis 1998 was a challenge for Malaysia, but it has brought Malaysia into a stronger state by improving from the lesson during the recession. The improvement has turned Malaysia into a more stable and positive economic cycle nowadays.